So in this video, I want to discuss some secondary factors. These are not the primary factors we look at when we are looking at investing or trading a particular stock. But sometimes these factors, which I'm going to discuss in the video, can give you some important clues about the health of the company. So let us look at that. They're already displayed on the main page. See, I've already mentioned that this page which MarketSmith shows, it's a very important page. There is a lot of information that you can derive from this page. Okay. So let us look at a company. Let's say I will type Dixon Technologies. I want to talk about these factors here. The factors that you see in this area: yield, book value, up down volume ratio, long-term debt to equity, alpha and beta. I have already discussed these factors in some other video. I have created a playlist called MarketSmith India Tutorials. In that tutorials, if you watch all the videos one by one, you will come to know how to interpret these values. You will also know how to interpret these values, what to look for. Okay. And you will also know how to interpret these values. So I want to cover these values in this particular video. So let's first look at the yield. What is the yield? So I click on consolidated. I don't look at standalone because the company can have subsidiaries as well. So we have to combine all of the data and see on a consolidated basis what's the plan with this company. So the yield is 0.04%. First, let us try to understand what is the yield. See, companies give dividend to shareholders. So if we look at the annual dividend of a company, let's say the company gives $1 dividend per share and the price of that share is $10. So that's a 10% dividend yield. Okay. So the dividend yield is the dividend divided by the price per share, the latest closing price. So this number will change every day. Okay. Now, just because the number is high doesn't mean that it's a great company. See, what happens is when a company makes profit, it can do three things with the profit. Number one, it could give a dividend to shareholders. Number two, it could invest it in the business itself to expand operations. And number three, it could buy back its own shares. So if this dividend yield is high, then you need to start asking questions. Why is this company giving dividends? Is it that the management is not able to find more opportunities to invest in the same business? Or is it that the management doesn't understand the importance of share buyback? Okay. Share buyback is something which I will discuss in some other video, but share buyback from the management is considered to be a positive sign. You can use the money in the treasury of the company to buy back the shares of the same company from the market, which reduces the number of shares and increases the earnings per share, increases this number basically. So if the dividend yield is high, then we better start asking questions as to why is the company giving so much dividend? Is there a problem with the business? Okay. Or the company does not understand the importance of share buyback. Sometimes in some businesses, you have to give a dividend because there are no growth opportunities in the business and the business keeps generating cash over and over again. And you need to give money to shareholders for them to incentivize to stay with the business. Otherwise, the shareholders might go to some other company. It's very easy to sell a stock. So if this number is high, that is also a problem we need to investigate. If this number is low, that is again a problem we need to investigate. Why this number is low? Is the company not making money? So this is a very tricky parameter. That is why I don't pay much attention to this, because dividend is something which comes after net profit. I focus on the net profit itself. If the company is making money overall, and if the earnings of the company are growing, I mean, how does it matter whether they are giving dividend, not giving dividend? This parameter can be mainly used to understand the policy or the thinking of the management. But on an overall business valuation point of view, this is not a primary factor. Okay. Next, book value. Book value is basically the equity of the company, the amount of money that the shareholders have put in, and plus the reserves, because when profits get accumulated, the reserves of the company go up. So that money belongs to the shareholders. So the total money that belongs to shareholders, the money that they put in plus the money that they have earned, the total money that belongs to the shareholders is called as the shareholders' equity. Now, if you divide it by the number of shares, you will get the book value per share of the company. Now, even this value does not make, it doesn't, I don't give much importance to it, because this number could be high or small depending on the number of shares available outstanding of the company. You might find a company where the book value is more than 43, but it could be because the number of shares are small, right? And the profits are the same for two different companies. So this number could be misleading. And this number on a standalone basis does not tell us anything about the company. Okay. So book value per share at the max, it could be compared to the price of the stock. So price of the stock here is 12098. Compare that to the book value, which is 43. So it is multiple times. The share price is multiple times of book value. This is price per share, and this is book value per share. So the company is trading at a very high valuation here, which you can see from the price to earnings ratio. So this is one thing I can do. I can compare this value, the book value per share, with the price of the share. That tells me what's the price to book value. This is not price to book value. This is only book value per share. At least this is what I understand when I looked at the MarketSmith product tutorial or product manual. This is the explanation that they have given. But as I said, these are secondary factors. Here are the primary factors. That's why they are given at the top. Okay. These are secondary factors, but sometimes looking at one of these factors can give you some insights on the company. So that is why I am taking the time to explain each one of these factors. Next, up down volume ratio. What is this? So basically, if you look at a stock over a 50-day period, every single day during those 50 days, you check whether the price has gone up on a closing basis. If it has gone up, note down the volume. And on the past 50 days, whenever the stock has been up, you add up all that volume, put it in the numerator. And during those 50 days, whenever the stock has been down on a closing basis, you add up all that volume and put it in the denominator and find out the ratio. What is the total volume on up days divided by total volume on the down days? Okay, that gives us whether there is demand for the stock. So if this number is more than 1, which means the up days are more than the up days volume is more than the down days volume, which means whenever the stock goes up, it goes up on higher volume compared to the volume when the stock goes down. So if this number is more than 1, it is a positive sign. It is a sign of institutional demand. So see, this number does not give us much to think about. There are a lot of, this is a very mixed factor. This number is also meaningless. It not, I don't pay much attention to this, but this is something we can pay attention to. We can specifically decide to buy only those stocks where this ratio is more than 1. Okay. If you keep that filter in mind, you will only end up buying stocks where the up volume is more than the down volume over a period of the last 50 days. So this could become one of your filters, your mental filters, when you are looking at all the parameters of the stock. So out of 3, 1 makes a lot of sense to me. Then you look at beta. This is important from my point of view, because beta 1.4 means this is like comparing the stock price performance with the performance of the index or the market. So let's say Nifty 50 index. So if the Nifty 50 index goes up 10% in 1 year, then the movement of the stock will be 1.4 times the movement of the index. So if the Nifty goes up 10%, then the stock goes up 1.4 multiplied by 10%, okay, which is 14% in that same year. Okay, so it's comparing the performance of the stock with the performance of the index. So this is a measure of volatility. So let's say this number is 1. If this number is 1, then the performance of the stock and the performance of the index is the same. But if this number is more than 1, then that means this stock is more volatile than the index. Okay, because if this number is 1.4 and the index falls 10%, then this stock will fall 1.4 times of 10%. So it is not just applicable on the upside, it is also applicable on the downside. Okay, so this number, if it is more than 1, it's considered to be volatile. The higher the value, the more volatile is the stock relative to the index. Very important point. Next is alpha. What is alpha? Alpha is again comparing the performance of the index with the performance of the stock. But this is kind of a different calculation. So what this alpha says is, assuming the index remains constant throughout an entire year. Now, when you compare the performance of the stock with the index, okay, how much has the stock gone up per day relative to the index? So this stock has gone up 0.5% every single day for the past 1 year when relative to the index. Okay, so I don't pay much attention to this because it's like it calculates the additional return per day compared to the index. Okay, I don't want to compare my stock with the index because that is already happening with the relative strength line. Okay, that's why I don't pay much attention to this. And it's not all, if you listen to the definition that I gave you, it's not very intuitive, right? If something is not intuitive, I don't pay much attention to it. This relative strength line is very intuitive. The slope tells me whether the stock is doing well relative to the index or not. Okay, so if I have the relative strength line, why should I look at this number? Then debt to equity. So basically, this is the debt in the numerator, equity in the denominator. Every company needs money to run its operations. Where does the money come from? The money comes from shareholders, and the money comes in the form of loan from banks or maybe institutions. Okay, so there is debt and there is equity. The question is, how much is the debt? How much is the equity? Let's say there is a company with $5 million of debt and $10 million of equity. So the debt to equity ratio is 50%, which means the company is financed majorly by equity, not by debt. Okay, which is a good sign. Okay, the shareholders are financing the business, they are running the business. But imagine if a company has equity of $10 million and a debt of $100 million, which means the company is run mostly by the banks, because it is because of the banks that the company is running. Otherwise, if there was no financing, the company would be out of the business. Now, in that case, the debt to equity will be 10:1, correct? Because the debt is 100 million, equity is 10 million. Now, that's a big problem. It's a highly leveraged company, right? So if the debt is 100 million, obviously you have to service the debt by paying interest on that debt. Where does interest expense show up? It shows up in the profit and loss account. What does that do to the earnings? It reduces this number, right? So if the debt to equity ratio is high, it will have a direct impact on the earnings of the company, because this is the net profit, net earnings per share. So if the debt is high, this number will be low. So we don't want to get into a highly leveraged company. This is only 7%. So this company is majorly financed with shareholder wealth, okay, shareholder money, which is a good sign. Okay, so if we look at Dixon Technologies, if we look at all these stocks, a conclusion I can tell you is, yes, the stock has been outperforming the index because this number is 0.25% per day. It is gaining extra relative to the index, okay, 0.25%. Beta is 1.4, which means the stock is volatile. It is not a highly leveraged company. And the up-down volume, the demand is not up to the mark. Okay, although the price is going up, it is going up on low volume. Okay, and dividend yield, since this is a growth stock, I can understand why the dividend yield is small, because they are reinvesting the profits back into the business. Apart from this, there is a lot of other information we can check, but at least whatever discussion I have done in this video, it will tell you what to look for and what do these numbers indicate, and what, based on these numbers, what are the kind of questions that you should be asking. Now, this kind of detailed analysis you do only when you are planning to take a positional trade. But if you are planning to take a swing trade, like short term, 1 or 2 weeks, you want a double digit return in 1 or 2 weeks, then these are not the factors that you look for. You look for strength, you look for price strength, you look for industry strength, you look for price near the 52-week high, you look for institutional demand, and you look for a tight base on the right side. That's it. That's all you need to check if you are taking a swing trade. But when you are planning to take a position in a stock and hold on to the stock till it remains above the blue line, which is the 50-day simple moving average, then you need to start asking questions based on these values. Okay. So I hope this video has been helpful. I repeat, these are the primary factors. I would say these 5 factors are the most important one. Rest, everything that you see here, this and this is all secondary. This is primary. This is priority 1. This is priority 2. And this is priority 3. Okay. And if you are taking a positional trade, then this starts to become a major priority apart from this. Okay. So this is how I have tried to explain this whole screen that you see. But since for every stock, you put any stock here, okay, you will get these values. You put any stock, you will get the chart and you will get these values here. Okay. So you need to understand how to read the chart. You also need to understand how to read these numbers. Okay. Very, very important. So I hope this video has been helpful. I request you to please like, comment, and share this video so that other professional stock traders could benefit from these little bit pieces of advice, or little bit pieces. I wouldn't call advice because I don't give advice to anyone. I mainly provide education. So whatever my understanding is, whatever my analysis is based on these numbers, whatever I'm concluding, I'm trying to share that with you so that you can look at these numbers the same way I am looking at these numbers. It will help you in your analysis, because the fact that these numbers are here indicates that they have value, because William O'Neill is a very reputed brand. MarketSmith India is an extremely reputed brand. So if they are putting these numbers here, there must be some reason behind it. So that is why I am taking my own sweet time to explain this to you. So please share this video so that other like-minded people like you who want to become professional stock traders can benefit from this information. Okay. Thank you so much for your support.